Hello, I'm Russ Mould, AJ Bell's Investment Director, and in this latest edition of our regular markets review, Breaking the Mould, I'm going to look at bricks, trench coats and beer. All three of them are capable of causing a fuss in the week ahead, because we have trading statements from a trio of firms in these areas, and they all come on the same day, Wednesday the 13th of July. And they are house builder Barratt Developments, luxury goods icon Burberry, and pubs group JD Wetherspoon. So, let's get going with FTSE 100 builder Barratt, which is due to release a full year update ahead of its actual final figures, which are due for publication in early September. Since the EU referendum vote, the roof has caved in on Barratt's shares, as it has across the whole house building sector, I should say, and Barratt has fallen to 2-year lows amid as yet unfounded fears that a UK house price and broader economic downturn may follow the Leave vote. This chart does show, however, that the stock had lost a lot of momentum before the ballot, owing to concerns over cost inflation and a softer economy. So let's see what Barratt has to say. The key operational metrics to watch will be as follows. Forward sales, which were £2.8 billion as of May's trading update. Legal completion volumes, which were up 9% at the first half stage. And average selling prices, which rose 10% to around 254 grand in the first half of Barratt's financial year. Chief Executive David Thomas may also give some indication on profits. Pre-tax income last year was £565 million, and analysts are looking for around £680 million for the year just finished. Just as importantly for the new year just begun, the market's looking for profits to come in broadly flat. Also watch for an update on the company's cash return programme. Barratt's planning to distribute 67.8 pence a share to shareholders from its net cash pile in the 2 years to November 2017. That's enough to currently put Barratt among the 10 highest yielding stocks in the FTSE 100, as shown by this graphic here, where the bars represent the yield and the line the dividend cover. Now that may attract income hunters, but investors need to do their research on the UK economy, the housing market, the builder's balance sheet and strategy so they can assess whether Barratt's proposed cash payments are safe or not. Another FTSE 100 firm due to offer a trading update on 13 July is luxury goods player Burberry, and this comment will cover the firm's first quarter. Now, boss Christopher Bailey is coming under pressure from shareholders who feel he's perhaps trying to do too much, given he's also the company's chief creative. The shares have struggled, as we can see right here. Bailey's presided over several disappointing sets of figures, notably back in May, when he talked down the numbers for 2017, suggesting profit would come in toward the lower end of the consensus range and, always a warning sign, be second half weighted. Analysts currently expect pre-tax income of around 395 million quid, some 5% below last year. Bailey's forecast of low single-digit percentage increases in retail sales also failed to inspire back in the late spring, especially if much of that seemed to be the result of planned store expansion and not like-for-like growth. Also back in May, to try and turn the situation around, Bailey unveiled a new initiative to take share in the luxury bag market, a fresh £100 million cost-cutting scheme and a £150 million share buyback programme. So the market will be looking for updates here, as well as signs of better progress in like-for-like sales, as Burberry battles a slowdown in China in particular. The third big trading update on 13 July comes from FTSE 250 pubs group JD Wetherspoon, which will be discussing how its financial year ended ahead of the publication of the actual figures in mid-September. Now, as you can see here, the shares haven't made much headway over the last 12 months, so they have been very choppy, owing to concerns over the impact of the living wage and fears of a slowdown in progress at the top line. The key numbers to watch are like-for-like sales, which were up 3.8% in the third quarter and 3.2% for the first 9 months, an operating margin, which fell from 7.4% to 6.5% in the third quarter, reflecting an average 8% pay increase for staff. It should also be worth checking out the planned 16 pub opening programme and the share buyback scheme, which could reach up to £60 million by summer 2017. So thank you for watching, and I look forward to seeing you next time.